I have to say, I absolutely love this photo. It reminds me of all the crazy trail runs I've done around the world over the years. And the one thing I learned from trail running is that when you're running through a mountain range like this, that to get to that next peak or that next summit, you first have to run through the valley in between. And investing in today's uncertain and volatile markets is a lot like trail running. A lot of ups, but also, unfortunately, a lot of downs. And at Firetrail, we believe we've just crossed that river deep in the valley after a very tough performance year last year. And we're now starting on that long, slow and grinding journey back up to that next summit. I really do hope you join us on that journey. Today, I'd like to provide some insight on how we are navigating those really volatile markets. Three key messages here. Firstly, the economy dichotomy. Why is it a lot of companies are racing ahead while there's also a lot of companies that have been left behind? What are the risks there, but also what are the opportunities? Secondly, navigating the cycle. Why is that important and how do we do that at Firetrail? And then finally, we'll talk about one great stock opportunity that right now feels uncomfortable, but we're very, very confident it'll be an outstanding opportunity for patient and long-term investors. But it's all about finding opportunities through the market cycle. So the economy dichotomy, we all know equity markets are booming, both here in Australia and globally. But at the same time, equity market valuations are at odds with current economic conditions. The tsunami of negative news is relentless out there at the moment. And that's pushing a lot of investors into that perceived safety at any price. And again, that comes with risks, but also comes with a lot of opportunities. So we know equity markets are booming. This is the Australian ASX 200. It's at all-time highs as we speak. You look at the valuation metric, price to earnings ratio, broadly also at all-time highs, trading at 16.7 times 1 year forward. Now we know at the end of the day, share prices follow earnings eventually. But what this chart is telling us is that the most recent market rally has got very little to do with earnings. It's all about valuation or PE expansion. Now, despite what the market's telling us, economic conditions have softened globally. And really the deterioration in sentiment around the world has a lot to do with the trade tensions. And it's not just US and China these days. It's also US and about 14 other countries. And even South Korea and Japan are having their own version of a trade war. And it really is this push to protectionism at all costs that really is spreading globally very, very quickly. And one of the many things it does is it stops company management from having confidence and trust in governments. When they don't have that, obviously the market's a lot more uncertain. As a result of that, they're less likely to invest. Simply put, lower investment by global management means lower global growth going forward. The second point is, why are central banks all around the world cutting interest rates? It really does appear to be a race to zero on that interest rate front. Well, we believe that the market or the central banks effectively fear a sustained and significant global slowdown. And the theory is he or she who cuts first will be best positioned when and if that slowdown comes. But this is the dichotomy. At the end of the day, reducing share prices are generally good for equity markets. However, not if earnings are flat or falling. At the end of the day, as I said before, it's share prices that follow earnings eventually. And then the final point, the Australian economy hasn't been immune from this downturn either. If you look at the consumer data from January through to May of this year, it was very clear to us that the Aussie consumer was in recession. But post the election in May of this year, we really do think we've got to get out of the jail free card, or won the trifecta effectively. We had the RBA had 2 rate cuts, probably 2 more on the way. We had easing of lending standards by APRA, and then finally we've got the tax cuts coming through in the next month or so. All of these are incredibly stimulatory to the Aussie consumer, at least for the short term. And right now there are some great opportunities in that segment of the market. But right now it's trade tensions that are dominating sentiment. So with all this uncertainty, where do you invest? Well, the vast majority of investors appear to be pushed into that perceived safety at any cost, whether it's growth, whether it's yield, whether it's REITs, infrastructure and the like. Now, some of that is actually rational behaviour. If interest rates fall, the value of longer dated and stable cash flows that are derived, say, from infrastructure and REITs actually go up in value. So that some of it does make sense. But we believe it's just gone too far. Some of these segments of the market here on the left-hand side are just incredibly expensive for us, and we can't find much value there. You look at the other end of the spectrum, industrial cyclicals and a lot of financials really are trading at recessionary lows, incredibly low multiples versus their history. It appears the whole market is steering clear of cyclicality at all costs. And this is what excites us at Firetrail. This is where some of the absolute outstanding opportunities right now. But again, you need to be patient and you need to be long-term. But the big issue now is low rates are driving investor sentiment. So how do you navigate the cycle? Well, over the past 15 years, there's been 5 distinct value versus growth cycles. I've only got 2 up here due to time, but what this chart's telling you is effectively when that blue line is rising, it's just saying growth companies as a group are outperforming value companies. So right now we're deep into a growth cycle from mid-2017 to where we are today. Growth companies have outperformed by around 15% per annum. But value also had its time in the sun post the GFC, where value outperformed for a number of years. The style or the cycle that the market in has a serious impact to an investor's performance through time. So as I said before, right now we are deep into a growth cycle. Now we don't know when that cycle will change or revert, but when it does, and trust me, it always does, it'll happen very quickly without any notice. And it's our responsibility to navigate that and position the portfolios effectively for that. And how do we do that at Firetrail? Well, we're all about uncovering great opportunities and investing in an eclectic mix of stocks that are undervalued in both the growth segment and the value segment of the market. And that allows us to, at any point in time, to position the portfolio into one style or the other. So right now we have a very slight value bias, and because most of the outstanding opportunities are in that segment of the market, we'd expect that value bias to gently increase during the rest of this year. And that leads us to the final area, uncomfortable opportunities. At our time at Firetrail and our 10 or 12 years on this fund at Macquarie, the best opportunities over those many, many years were the uncomfortable ones, the ones that no one else wanted to invest in. They were unfavoured by the market as a whole. And I wanted to talk about one of our uncomfortable but great opportunities right now, and I'll do it as a quick who am I to see if you can guess who it is. To give you a guide, I've already presented in the Gold Coast and Brisbane. Brisbane got it immediately. Gold Coast had no idea, so we'll see how you guys go. So who am I? Cast your mind back to 2014. I was unloved and famous for all the wrong reason. There was a front page newspaper with the caption, "Is this the world's worst CEO?" with the unfortunate photo of the CEO at the time, and that CEO still sits in the chair today. I delivered $1 billion of loss. I had to suspend dividends, and there was a real chance of an emergency capital raising. Now, fast forward to where we are today. I actually generate $1 billion in profit, and I have done for a couple of years now. I've reinstated the dividend, 4.4% dividend, fully franked, growing. Gross that up, it's about 6.3%. And no, I'm not a bank, even though I'm growing stronger on the dividend front. I've bought back over 25% of my shares on issue, and I'll continue to do that going forward. Now, to be fair, from my lows, I've already rallied around 400%. But today I'm only trading on 9 times 1 year forward. So a 40% discount to the market and a 30% discount to global peers. So who am I? Anyone? Come on, there's 500 people here. Qantas, very, very good, easy. So a big tick. So it is the world's best airline, it's Qantas. We value Qantas at over $10 a share. It operates in a far superior industry structure than its global peers, but it trades at a 30% discount. Its only competitor in this market, Virgin, is still not profitable today. That allows for rational, competitive behaviour between the two, and as a result, we've all experienced increased ticket prices through time, which increase profits clearly. But the one big positive for Qantas now is the Qantas Frequent Flyer program. It's Australia's best and probably one of the world's best customer loyalty programs. Now, in the past, it's always been hard to value the Frequent Flyer program because it's a great growth company or segment within Qantas, growing EPS 10% per annum year in, year out, but it's attached to an industrial cyclical. But now Virgin's Velocity business is about to get IPO'd, and if we put the same proposed multiple on that's on the Virgin Velocity business on the Qantas Frequent Flyer, Qantas Frequent Flyers is worth over $4 a share or over 75% of the current share price. And Virgin, as I said, that business will get IPO'd later this year. So it's far too cheap it's a great stock for us. It's too cheap across all metrics, whether it's its peer group, globally, its own history, robust earnings, and enormous optionality on that frequent flyer program. So thanks very much for your time today. Low rates and fear are driving investor behaviour. It's pushing a lot of investors into that price to perfection. And there are risks on the horizon there, so you need to tread carefully. And finally, there are a lot of opportunities out there, but it's only for patient and long-term investors. It's the uncomfortable opportunities that we believe are the best long-term opportunities. So thanks for your time.